Let's get rolling.
Yep.
Thanks everybody for joining us at our weekly update. Where do we want to start first? A couple of key things, upcoming holiday hours. So next Wednesday, we're closing the office at 3 o'clock, trying to get home a little bit early for Thanksgiving. Hopefully everybody understands that. November 28th, we're open all day. No, I'm kidding. We're close. It's Thanksgiving. We're going to be closed that whole day. And then Friday, November 29th, the market closes at noon. And our team is going to be working remotely that day. If there is something that comes up, try to let us know ahead of time. But coming in for a half day when people are trying to relax.
If you need something, we can have somebody get to the office.
Yeah, we can.
It's not a problem.
Just we find that to be usually a very, very, very quiet day. So we're gonna try to make it a little easier on everybody. With that, let's get right into the questions. Remember, if you have questions, service@o'harewealth.com, or you can text us 414-644-0060. You want to start? You want the first question?
Sure.
All right, sounds good. Can you explain the U.S. government, how the U.S. government will deal with all this debt? So great. Can you explain a huge topic?
This will take about 4 hours. Seriously, it's becoming more and more of an issue. The markets are paying attention to it. There's been quite frankly, kind of brutal bear market in the long-term bond market, including U.S. Treasuries.
Yes.
Because of a concern about not only inflation might be stalling out at 2.5%, but neither candidate that ran for president talked about cutting spending. If anything, both candidates tried to outcompete each other with new spending, and both plans add trillions and trillions of dollars to the debt. The debt's already 35 trillion. And to put that in some perspective, if you go back to the housing crisis, which is, not quite 20 years old now, but our debt was about 8 trillion. So it has grown significantly from that time. So debt is a problem. The United States is very unique in the fact that we are the world's currency reserve, what the dollar is. So we get better lending terms than anybody else. And the dollar is considered the safest place to go, and our treasuries are considered the safest place to go. So it's one of those questions you can't say, well, at 35 trillion in debt, if we hit 40 trillion, everything goes to hell. That's not how it works. It works when markets stop buying our debt. And right now, they don't seem to have a problem to continue to buy our debt, and the debt sales are going well. In fact, the U.S. Treasury, I think, is the 10-year is 4.4 today. Greece puts out 10-year bonds at 3.2. So we're paying better than a small, tiny country with a weak economy like Greece. Japan pays 2%. I think the Germans pay 2.8 or something. Britain, I think, is very close to us, but we're still one of the highest rates out there. That's where investors are going to go. Now, I think we had a chart. I don't know if they have it available, but let's see. Oh, good. I ran across this the other day, and it's the growth in debt to GDP. That's another way to measure this, is looking at this chart going back to the 80s and even the early 2000s. Our debt to GDP was 50%. And that, by most economists, is considered very, very manageable. It shot up significantly after the housing crisis, and then shot up again because of COVID. But they do a comparison. The same thing happened. If you go back to the early 90s, Japan had 50% debt to GDP, and it's grown to 200%. And you're not reading anything about Japan collapsing, or no one will buy Japan's debt. They keep buying it. And that's on the left side of the screen. The right side shows you what it says JP, that's Japan, 10-year yield. It was near zero 4 or 5 years ago. Now it's up to 1%. So the Japanese, with twice as much debt to GDP as us, are paying 1% on their treasuries. We're paying 4%. And look back that whole chart. As their debt was growing all these years, we've always paid more. for our debt that Japan has. Now, some of that was structural in Japan because a lot of their citizens buy a lot of their debt, but they do sell debt overseas as well. So you can't just say, hey, it's all going to collapse because we've gotten so big. I will tell you, it's something we're watching. It certainly is on the market of the bond investors. We're hearing a lot about it right now, and they're worried about all spending's coming up. And you know what? It's too bad if you're trying to get a mortgage, we're not going back to very, very low rates. I think we're in a new world, which is really the old world, that you're going to pay 4 or 5% for long-term debt. Mortgages are going to be 6 or 7%. But do I see a disaster? Do I see us, running into a wall and everything falls apart? No. This will more than likely be a slow problem that we have to address over time with cuts in spending. But current administration, regardless of, doesn't matter who got in, no one wants to cut right now. Someday, if our 10-year rates go up to 6% or 6.5%, they're going to have to cut debt, and they're going to have to cut costs. So
Yep, and
we'll see what happens.
We'll go through what we like to call a series of small crises, in which basically our government now is set up that it only acts when there's a crisis, and we'll have a whole bunch of them. And it'll seem like every other year we've got a crisis where they come together and they cut benefits or cut spending or change some form of the debt structure. And that'll sort of be the norm for a while as we readjust. It doesn't just hit one day and the lights go off. It's not exactly what happens.
Yeah, great point, JJ, because they will cut benefits like Social Security and Medicare. But that's what happened in the early 80s. We hit the same spot. It was a crisis. And the Reagan administration and the Democratic Congress got together and they changed all the retirement age. It's not 65 anymore.
Nope, not for anybody else.
Nobody. It's 67, but they'll do the same thing. They'll change it on the younger people first.
Yeah.
But you're going to hear a lot about it because they're going to have to address it. But again, our government doesn't do things unless there's a crisis.
All right.
Next question. I have enough stocks. What else can I buy besides bonds?
Yeah, bonds. Well, we just talked about, when we did our quarterly outlook, we talked about bonds at 3.8% on the 10-year. We said we were very fearful buying long bonds and going long duration because we thought bond rates could go up. Of course, we're sitting here, 7 weeks later, and they're 4.4. It's an undertold story, but if you bought 10-year bonds the day we said that, you're down like 20%.
Yeah.
So you buy US government debt and you're down 20% in 6 weeks. It's been a massive shift. So I understand why people are hesitant to buy more bonds, because they're also worried about where rates are going to go. And if rates, as we just said, might either stagnate or go up, you don't really make a lot of money on them. You just sort of collect your coupons. So what else can you buy? The big thing is structured notes, which we've talked about before and at length, and we've got a whole presentation on that we're working on. They're a differentiator. The other thing we've talked about is alternative investments. And we're on a broad call with a lot of people out there. So I obviously don't want to give people direct as to what you need to buy. This is not direct advice. It's got to be, well allocated. It's got to be a percentage. You got to make sure your liquidity is correct.
There's qualifications you need to meet to buy some of these investments, and it's different levels of wealth. So
yeah.
But this is just broad.
We've looked at places that do buy data centers. I mean, I know it's been a big conversation for us. We've talked to people who build them and then lease them out. We've talked to people who are doing sort of different things with biomedical science. We've looked at alternative investments, either with private credit, private debt, and private equity. And those are another differentiator that's far and away. And I don't have this chart, but being great at picking stocks and being bad at picking stocks, there's a pretty wide gap. It's a couple of percent per year. Being great at picking bonds, being bad at picking bonds, there's like a 0.5% gap. It's really pretty small. But if you're a bad private real estate investor, it's like a 10% gap. If you're a bad private equity investor, it can be a 20% gap. If you're a bad private debt investor, it can be like a 7 or 8% gap. It can be absolutely huge. As a matter of fact, those I would argue need even more time, due diligence than almost anything on the public markets. So when we are looking at them, it's a big undertaking for us, and it's a big part of what we've done in the past, big part of what we still do. But that is one of the first places to look. So if you have questions about that, we're happy to take that call.
Yeah, we have access to alternative investments and we talk to most all our clients about it. But if you're concerned and you don't want more bonds right now, yeah, let's have that discussion.
Yeah, it's ever expanding. We're talking about a new investment tomorrow. I've got a part of a diligence call tomorrow afternoon. So we are constantly looking at expanding that group. So we're excited about it.
Yeah. And I would just say the structured products, or we call them market links. Market link notes we've been using for 15 years now. They've worked out very well. And the returns have been, 300 to 400 basis points or 3 or 4% higher than bonds over time. So it's still worth looking at.
Next question. Should we sell stocks before the new year? It seems like a correction is coming. You taking this one?
Sure, I'll take this one. I think we both have the same answer. We're just bad at timing the market. And we've gone through this. I should have brought the chart I just ran into showing how if you miss the best 30 days over 5 years or 10 years, you end up with half the returns of the market. So we've been adamant for a long time we're not good at timing the market. And the problem is we could be right for 90 days here. And then if we don't get back in, we're going to be wrong for the next 5 years. And we can talk about this. The market peaked before COVID. And if you had got out because of COVID, you somehow knew it was going to be bad. You missed a 35% decline in the market. But if you didn't get right back in, you missed an enormous rebound. Plus, we've gone up. What are we up since COVID? 50%?
Yeah, at least.
Yeah. So it's, again, the reminder is stocks are long-term investments. If you're not going to be into them in the market for 5 years at a minimum, you shouldn't be owning it. And even if you're retired, you're taking out 3, 4, 5% of your portfolio. A good chunk of your portfolio is going to be around for 20, 25 years. It should be in stocks. But if you're shorter term, 5 years or less, we have other alternatives. And those are bonds. The market link notes can work very well for that. But yeah, if you ask me right now where the market's going next 90 days, I'd say correction's overdue. But I don't know if that's a 7% correction or a 17% correction. And if it happens, I'm going to have to make a quick decision to get back in.
Well, on the flip side, I think if you asked us probably 90 days ago, would you expect a correction? I'd say, yeah. And of course, the last 90 days have probably been wrong. So, if you look at our quarterly chart party, I think, we talked about the market being overheated in March, and then we got a correction. And then it looked like we could time the market. And then it happened again in June. We talked about the shift.
Yeah.
This year, we talked about it happening again. I mean, it seems like sometimes we can time the market based on what we say is going to happen. We just talked about the bonds. It feels like, well, you guys said it was going to happen. It happened in 6 weeks. It's still really hard to time. And the market the market can stay irrational longer than you can stay liquid. Even if you know something's going to happen, the market can wait you out more than you'd like to.
Yeah, and JJ did our market comments this week. If you look at a recession as a word right now, there's really not the conditions for a recession currently. The only problem with the stock market is the valuations on the high side. And you know what? Historically, using valuation alone to get out of the market hasn't worked for me.
Well, I know people talk about that in the past. If you use valuations as a way to get out of the market, you shouldn't have bought anything basically since 2012.
Yeah.
And then you would have missed a pretty big move. But that's, using just valuations is a hard way to do it. And the only thing we can't predict is a black swan type event, something that sort of comes out of nowhere and unravels in a massive way. That's even harder to predict. And so COVID was one of those examples where, six months before COVID happened, we didn't know that disease existed. It's hard to see that coming.
And you're going to get another one. There's COVID. It was the Russian invasion of Ukraine.
That was another one. Yeah.
I lived through 9/11. Came out the blue. The market closed for weeks and then imploded. I mean, yeah, you're going to have another one. We just don't know when it is or what it is. But I'll tell you this: look back at 50 or 60 easy years of history, there's always an event that comes up that looks like a disaster. But good investors, long-term investors, you just live through it, and we'll live through the next one.
With that, I think we're gonna wrap it up, unless you got something else you want to add.
No, wishing everybody happy holidays. We won't be on next week because we'll be eating turkey and watching football all day like
That'd be
everybody
fun.
else.
Thinking in bets, I know we both read this one. Talking about timing the market, this is exactly why you don't do it. If you are playing the odds, the market goes up 79% of the time. You should always want to be in. You should always be taking that bet. And because of that, it's hard to time the market. Occasionally you're going to be right, but it's like rolling the dice and saying it's going to come up a 6 this time. Well, you know, the odds are 1 in 6 chance. So eventually one day you'll be right, but all the other times you're wrong will be very costly. So with that, we're gonna wrap it up there. Thanks again for joining us today, everybody. Any other parting words?
No, just enjoy the next weekend. And I just got back from Florida 2 days ago, so I brought all the snow with me. I guess
It's been great.
It's snowing because I got back. But we'll see you guys in 2 weeks.
Excellent. Thanks, everybody.